Well, in some ways it's too early to say because Brexit hasn't actually been triggered yet. So it's very, very early days. What we've seen so far is actually not an awful lot. There was an initial period of 2 to 4 weeks afterwards where there was a lot of market volatility, stock markets dropped, currency plummeted, obviously a lot of political upheaval. And there was concern there would be panic selling, but that hasn't materialized. We saw some retail funds put a block on redemptions and consequently sell some major assets. But even in the midst of all that volatility, the biggest discount on the commercial side that we saw was a 10% discount post against pre-Brexit. So that actually gave the markets some confidence that the big institutional investors felt it was, they still bought into the UK in the long term, and some of them saw it as a buying opportunity. So that on the commercial side, pretty steady, and there's still a lot of money chasing prime assets, long-dated income, safe, secure investments. The residential side has been a bit more tricky, but that actually has more to do with tax changes than Brexit. We've got two opposing forces. On one hand, uncertainty, which surrounds Brexit. On the other hand, the cheap pound has kind of turbocharged people's attitudes towards investing. And we've seen, especially in the last few weeks, when the pound dropped again, a resurgence of money into residential in London and also in the regions, in some of the big regional cities, Manchester, Birmingham. So, we'll see again come next March when they trigger Article 50. On the pricing side, I think the drop we've seen, which is actually a fairly modest drop, is down to investors wanting some kind of, especially with the bigger lot sizes, that they expect some kind of discount. But there's very limited supply of prime investment stock, and there's actually a lot of money in the current environment. There's a lot of equity, and the cost of borrowing is cheap. So for the right asset, there's a lot of money waiting to pounce. And we saw that, for example, when Aberdeen Asset Management put one of their big buildings on Oxford Street up for sale just after Brexit. It was sold off market within a day of deciding to do the deal to a Norwegian bank. So there's no shortage of liquidity for the right asset and at minimal discount.
As a company, why did we look at investing in the UK? Initially we looked at the US, at Europe, and then in the UK. We ended up selecting the UK because primarily it's a landlord-friendly market, and in terms of the legal system, it's quite transparent, and basically it's quite liquid when you compare it to other markets. And if you look at after Brexit, this hasn't changed. So to us, we still see opportunity in the UK. Currency has weakened, so this is an opportunity for us being dollar-based investor. We see potential. And in terms of, like you said, I think one of the issues that's affecting some of the real estate on the residential is these changes in stamp duty, which happened last year. And that's definitely has affected the market. But in terms of the commercial, we see there are some opportunity that, that could be available. And we're still considering UK opportunity. Just as an example, last week we bid for an asset, and unfortunately someone else came in and paid, overpaid for it. Not overpaid, I mean compared to our price, they basically overpaid. As a long-term investor, you're looking at the dynamics of the country. I mean, if you compare the UK to Europe, UK is still doing better in terms of economic growth. And looking at if we have investors trying to look for real estate, there are not many places where you can get good return. And with interest rates being low, on a yield basis, leverage yield, you can get 6-7% easily. So that's still, it's an attractive market for our investors.
I think we envisage more in the run-up to next March at least, when Article 50 is triggered, more volatility. It is a given. And coming back to your question at the back of the room, why haven't we seen any big reactions following that period of volatility? I think it's because there haven't been an awful lot of transactions taking place. The ones that have taken place tend to be prime assets, long-dated income, single tenant. And like I mentioned earlier, there is a wall of money chasing those assets in most of the major cities in Western Europe and the UK and the US. So that's why they've been snapped up. But it is uncharted territory. I think if we start with, in fact, in reverse order, I think you mentioned commercial first and the City of London. I think there is potential downside there and there's potential risk for obvious reasons. Where we're seeing interest is in more long-dated investments. So if you're looking at an office building in the city or in Canary Wharf with, say, 2 to 6 years of income left before there's a lease renewal, there's inherent risk in that. And this process of Brexit could go on 2 years, 4 years, who knows? I mean, Europe has spent 7 years negotiating a free trade agreement with Canada and still haven't worked it out. So if you're looking at commercial investment with income of 10 years and beyond, we still think, and if you're looking for blue chip investment, we still think that holds interest. As for the currency, it's true, no one knows, because you go from parity up to $140 v pound, and the other thing to bear in mind is the exchange rate isn't just based on Britain's reaction to Brexit, it's based on what the American economy's doing. And we've got the prospect of Donald Trump being president in a few weeks. So it's a hard one. I think you have to stick to the fundamentals, which are, the pound is a bonus, but you have to invest in the country. That's the most important thing. For residential, there have been some big changes in tax. Like Richard said, a lot of them politically driven, a lot of them driven by, quite rightly, a global crackdown on money laundering, making sure that, that is wiped out, which has actually inadvertently affected a lot of the majority of good, decent investors. I think these tax changes have been absorbed by the residential market. So what we're finding, they tend to affect central London more, and you'll find that the extra 3% on stamp duty, which came in recently, developers will discount that amount. So the market has absorbed that. I think, will the government bring in any more onerous taxes on residential investors? My feeling is a strong no, because it's had the desired effect. One of the desired effects was to cool the market, and it's done that. So there's actually no need to bring in any more now. And plus, for many reasons, the UK needs to be open for business over the next couple of years with the prospect of Brexit. So why make yourself more uncompetitive? So I think the market has absorbed the tax changes, and I don't think there will be any more. That's my opinion.